Well, hello, hello, hello. Welcome back. It is July 26, 2022. Stephen Meade with Domicile real estate for people who love houses. And this is our Southern California housing market update. No, it's not a title. There are big changes coming to these videos. And I wanted to just take a second to talk about that and why we're doing that. For basically, since the pandemic, we started doing these videos because the market was very uncertain and people were scared about a lot of things. And frankly, we needed something to do and to prepare for every week. And I think a lot of our clients and viewers out there needed the same thing. And so we started off just doing a whole market update once a week. And then we added in a market update for first-time home buyers every week. And one of the things really that I think has happened is I'm happy with the work that we produced. I'm happy with what our clients think and the information we've been able to provide. But I feel like it's actually been at the expense of some of the other things that we've wanted to do, and that weekly videos are maybe a little bit too frequent, and that some of that energy might be better directed to do some videos that are a little bit more topic specific, where we dive in and we jump in on something. So what we've decided to do is alternate. So one week there will be a video for our whole market update, which is this video. And then the next week there will be a video for our first time entry level home buyers. So basically these videos, which are now weekly, will move to bi-weekly videos. I think that's a little bit better, and that will give us a chance to do a second video each week that is a little bit more topic specific, or involves kind of a cool story or a lesson, or just something fun that we think is timely. And we've had a lot of these ideas, but it's kind of hard to get them into the stream. And I think that this will be kind of better. I think it'll give you guys some more varied content. It'll also, give us a chance to kind of talk about some of the things that really we spend a lot of time talking about with our regular clients, but we don't necessarily get a chance to share with all of you. And I think some of those things are important. So big changes are coming. This is going to be the last week where we have 2 videos going. So in the future, we will be doing, from then on forward, we will be doing 1 video per week. That's a market update, alternating between our whole market update and our first time buyer market update. So let's go ahead and jump in though, and let's talk about what's happening, because there are some cool things happening in the market right now. So first thing I want to talk about is we are seeing the number of active listings on the market leveling off. And that's really happening for 2 reasons. You can see down here in our under 1 million category that the shape of that curve is flattened out. And where is it ending up versus where we are last year? I think, none of these numbers exist in a vacuum. Last year we were at right around here, around 6,000 active listings under $1 million. Where are we right now? We are probably at around maybe 8,000 active listings. So, 6,000 versus 8,000, that is up about 33%, but it looks like it's leveling out. 1 to 2 million, where were we last year? We were maybe around 2,800 listings. Where are we today? We're probably around 4,600 or so. So still a pretty healthy change since last year, but again, you can see the shape of these curves leveling out, and that is a sign that the market is finding sort of its equilibrium, its sort of spot of stability. We've talked about that a couple of weeks, but really, I think the data is pretty firm that that's what's happening at this point. So let's look at new listings coming into the market. I think this is the one where really there's the biggest change. So our level of new listings in the 1 to 2 million category is about the same as it was last year. This is new listings coming online. And we've talked about this a little bit before. Part of these ranges are a little misleading, right? Because a year ago, 1 to 2 million was a slightly different price category than it was this year because of, just inflation of housing and of goods in general. If you look at our new listings for our under 1 million, that number is really pretty low. It's a little cyclical here, but it's kind of heading down on both of these. And I'm really curious if that trend's going to continue. I've got to be honest. One of the things we do for our architectural clients is we review all of the new listings that come up in certain age ranges, mainly mid-century modern and historic homes. And I have to tell you, there are fewer and fewer listings coming up. It absolutely is less than it was last year. If we take these numbers together, what are we at? 1,500 and maybe 2,900. What is that, a total 4,400 versus last year? We were quite a bit higher than that. So part of the reason that those inventory numbers are flattening out is because listings are down. But simultaneously, what are we looking at here? We're actually seeing a little bit of a rebound of new escrows happening. It's not a super strong rebound, but it's definitely a change in direction from this downward trend, right? And I'm curious to see whether that's going to hold up or not. I think a lot of that's driven by interest rates, but I think part of it is driven by this notion of confidence. And one of the things that I try to tell people economically that's a factor that many people underestimate is this notion of certainty and comfort. So we have consumer confidence indexes. I don't always think those track with housing, right? Those track well for luxury purchases. They don't always track well for housing purchases. I think housing confidence has a lot to do with this sense of certainty of what's happening in the market. And a month ago, you had half the people saying there's not going to be a crash and the other half saying there's definitely going to be a market correction. I think if you were to look at those percentages today, far fewer people are talking about a correction in the Southern California housing market. And I think what that's doing is that is giving these consumers confidence. I think they're also just used to the higher rates. It was a bit of a shock and an awe when they called their mortgage broker to get the current rates a month ago. Now, maybe it's not quite so shocking anymore. And look what we see reflected like in these absorption rates. Now, there's always a little bit of noise in the signal, but I think this is a pretty firm statement. And I'm going to stand by this, that I don't think this is just a little bit of noise in the signal. I think these absorption rates have bottomed out and they're either flat or heading back towards the 70% number. What is that number? What does that mean? It means it's a pretty mild seller's market. So sellers still have a little bit of the upper hand, but not always and not definitively. It means there are still deals out there. There are sellers who need to sell or desperate, and there are going to be homes that get multiple bids. If we look at our closed prices, remember, this is looking back to the contracts from 4 to 6 weeks ago, we definitely see a little bit of softness in all of our ranges. Not only that 75th percentile, which I think really shows a little bit of a downward bubble. Again, this is the range that might be more affected by consumer confidence. The median has really been pretty flat. Like, we don't see a huge downward trend line. It's maybe slight. Same thing in our entry level. A little bit of momentary down, but I'm telling you, from what's on the ground right now, we actually have a pretty healthy market when it comes to supply and demand being in balance. They are a lot closer than they've ever been, I think, at any point. If we're looking at still active, right, we saw this number really rise up as interest rates went up, and then it's kind of leveled out. Another sign, again, of sort of stability and equilibrium seeking behavior. We're getting much closer. These moves are not huge swings in the market. There's a sense of stability, a new normal. People have confidence and they know what the market is going to be like when they go out there next weekend looking for houses. And then if we look at our close to list ratio, this is perhaps my favorite. It is a return to reality. And what do we see happening here? I always describe this close versus list price ratios as, you've heard me talk about this before. This is really talks about how far different are buyers' expectations and sellers' expectations, right? When you start seeing those close to list ratio go under 100%, that means that sellers are a lot more optimistic about what their house is worth than buyers think it's worth. And when you see the opposite, when it's over 100%, it means that buyers are fighting for whatever they can get. Sellers are almost caught off guard by how many offers they get. 100%, 99 to 100%, 101, that's really in that range where those expectations are pretty close and in line with each other. And that's really what we've seen track here. We're maybe 100.5% under $1 million and 101.5 for our 1 to 2 million price range. So really we're seeing these are finally actually tracking in kind of an area where we see again, kind of that balance of supply and demand, those balance of expectations. If we look at days on market, yet another piece of information that is pointing towards a bit of an equilibrium and stability in the market, these numbers came up and now they are settling still under 30 days, by the way, just so you're aware. But I think it's important to note, this is days on market for new contracts. So these are the homes actually selling. I think you'll find, and maybe we'll do a chart based on this, that the days on market for the homes not selling is on average quite a bit higher than it's been, but the ones that people actually want, those numbers really have not risen by huge amounts. The reason why we continue to track this and not both is I like having this history. I like seeing where are we versus last year. I like seeing that context for these numbers. And then we have the three-way, right? And the three-way, if you'll notice, our payment index has tracked down a little bit. And that rent index, it's this differential, right? That is to me the market warning sign. When you see the payment index on housing to buy get radically out of whack with the rent index, that's really the sign that you've got problems in your market brewing, because that is a disconnect that cannot exist indefinitely. The market needs to correct that in some way. And the way that got corrected here was rents basically rose and jumped to meet sort of this new world, this new balance of renters versus buyers in our market. Now we're actually seeing a little bit of downward pressure on some of these payments due to reducing interest rates and a little bit of price relief, very mild. And that really is having, I think that might actually leave room for some price increases to happen. We'll just have to see about that. We look, where are our mortgage rates? They're right in those mid fives here. And we've kind of been in this, we jumped up to this 5% zone. We've been playing within there. The trend line sure is a little bit up, but if I could predict interest rates, I wouldn't be doing videos on YouTube. I promise you, I would be sitting on a beach, drinking little drinks with umbrellas in them without a care in the world if I could predict interest rates. So anybody who tells you they can predict interest rates is doing some guessing, hopefully with a little bit of education behind it. But, really historically, interest rate markets are notoriously difficult to predict in anything other than the immediate term. So many things affect these that are really kind of black swan type characteristics, war breaking out, things that are sort of unexpected can affect interest rates in ways we can't really predict that well. So, I tell people they are what they are. I don't know how long they're going to be like that. We can talk about some long-term trends, but really in the short run, it's anybody's guess what interest rates are going to be next week. So that's pretty much all we have for you. Big changes coming. We're excited for some of the new content that we can bring out. Kind of excited to do some deeper dives on things that I think we've wanted to talk about, things we've done for other clients of ours. And yeah, that's pretty much it. Questions, comments, we love them. And we are a full service brokerage in Southern California. So if you have any need to buy or sell residential real estate, especially architectural properties, it's kind of a bit of a niche of ours, or if you're a first-time home buyer, we'd love to hear from you. Definitely check out the methods below to get in touch with us. Don't forget to like, subscribe, and hit that notification bell so you'll see some of that great new content we have planned for you. And yeah, have a great week, everybody. We'll see you again real soon.